I guess I'll turn to you first, Constance. You're the economist. Explain these numbers to us, because I mean the overall job creation number is just through the floor.
Right.
It's fallen off, but at the same time we're paying people more for it.
So I said something in an earlier segment about you have to look at the revision and you have to look at the average for the quarter so far. So we're averaging about 180,000 jobs per month. If you take January and February together, there was always going to be noise in this as a result of the shutdown. And so I think that if we look at that average, you're looking at about 180,000 jobs a month. That's where we should be given this phase of the business cycle, given the growth rate of the population.
Well, and ironically, on the revision, people were concerned that they would revise it down, that 304,000 number, which is so big. They revised it up. It was 311.
And they revised up December. So it's not unreasonable that we would have a little bit of a pullback here in February, given two really strong months and months that are growing faster than where we would expect them to be given this phase of the business cycle.
Boy, and I'll tell you, there's an immediate reaction in the dollar spot index there. It has really fallen down, as you might expect. And
oh, I'm sorry. Yes, yes. This is a very odd jobs report. It's I agree completely with Constance that you really have to look at it over a couple of month period. I think that's a pretty normal reaction for the dollar to do that. I think this is such a catalyst-driven market right now. But I think we need to sort of think a little bit like the unemployment rate falling another percentage point or so. I think that's important. Continuing strength in the job market. I think if you kind of ignore this very odd 20,000 number, which is so incredibly low on the face of it, it is probably a jobs report that the Fed should feel pretty good about.
Well, I was going to say, because this, I mean, seems to me more of a full employment kind of conversation. You wind up hiring less people, but those that are in the market are getting paid more, and labor force participation rate kind of goes nowhere. That to me signals a tighter market. So, Subadra, your short bonds a little painful at this exact moment. However, where's sort of the bounce in yields here? Like, where's the support level on this immediate kind of reaction to the downside?
Well, you're not seeing that much of a rally in tenths. It's just about a basis point. To me, what really stood out in this number is the fact that, you know, wages are starting to tick up. We're at 3.4% year over year. And this has been consistently growing for the last several months. And at some point, you know, you're going to have to start, you know, being concerned about, you know, wage pressures and wage inflation. We're not there yet, but that's definitely something that stands out in this report for me.